Hello and welcome to this Friday's weekly wrap-up, where we will be taking a look at some very significant market movers this week. Joining me to discuss is Craig Erlam from OANDA. So top talks on Wednesday led to the Greek Prime Minister rejecting proposals that would unlock bailout funds. A stalemate was reached and the payments have been postponed. So what is next for Greece and the IMF?
So I think the most important thing here is this shows what Greece's priorities are. They've only got a limited amount of funds and they've prioritised making payments for public sector wages and pensions, which I think is very important because it shows that if these payments externally aren't essential, then they are prepared to skip them. Now, this only really applies for the next few weeks. There's not really any big payments due, apart from the IMF, over the next few weeks. So this gives them a little bit more time to negotiate with the creditors. Now, they've rolled up these four payments into one payment on the 30th of June, totaling 1.6 billion euros. Hopefully a deal will be in place by then because I don't think they'll be able to actually make that payment without one. But it does take a little bit of the pressure off. So there is a positive here, and this does allow negotiations to go forward. The downside really is that if we've not seen any real progress over the last 4 months, or what progress we have seen has been very minimal, we've not seen any of these supposed red lines actually moved from either side. The sticking point still seems to be VAT and pension reforms, and neither side seems willing to budge on this. The only area where we've really seen any progress so far has been on the fiscal surplus targets, which have now been cut back to 1%, or which both sides are willing to agree to 1%. So I still think there's a long way to go in all this. I don't really think today's has a huge impact really on the outcome. What it does just do is give both sides a little bit of breathing space, and as far as I'm concerned, when we get to the end of the month, it wouldn't surprise me if we see either a referendum on any deal that's been agreed, which is going to be unfavourable for Greece because I just don't see their creditors actually moving away from their demands, or we'll see elections because the Syriza party have been firmly against this more austerity being imposed, and if they were to then accept it without a referendum offering its support, then they'd be effectively going against their mandate and they'd become very unpopular very quickly.
US non-farm payrolls are a key indicator of potential interest rate hikes in September. Are you surprised at the figures today, reaching 280,000? And what does this mean for rate hikes?
I'm not surprised at all. I think this whole slowdown in the US has been extremely overplayed. If we remember back to the first quarter of last year, we had this poor weather which really weighed on economic growth in the first quarter. A lot of the data was pretty woeful back then, and I remember this same panic going around that the recovery had stalled and all this worry. And then we came back to the second quarter, saw a strong rebound in the second quarter, and I said in the fourth quarter we're also very strong as well. And we've effectively seen as a slowdown again in the first quarter, weather-related, dollar-related, of course, and also the decline in the oil prices had an impact on investment as well. But again, I think all these are temporary things which are going to weigh on the economy, and I think it was only a matter of time before we were going to see the rebound in the economy. Now, it did come a little later than I was expecting. I thought it may come in April. We've had to wait till May, but now we've seen this strong jobs report. And to be honest, I think people are going to focus, yes, on that 280,000 jobs added, and that's completely understandable. It's an extremely strong figure, and it shows that companies' outlook is extremely positive. But the most important aspect of this report for me is the fact that 0.3% wage growth in May. This is what the Fed has been waiting for. The Fed has a dual mandate: full employment. Now, by their own measure, employment is now at full employment, between 5 and 5.5%. The other part of their mandate is inflation, and for inflation to be at or above target, we need to see wage growth and we need to see spending. Now we've got wage growth. We've got wage growth at more than 2% on an annualized basis. We've seen 2 month-on-month increases of 0.3%. That is very positive going forward. All we need to see now is consumer spending, and I personally think we'll see a bounce back from that in May. We saw a big increase in hiring in retail outlets in May. That suggests that shops were either expecting further spending or were experiencing higher levels of spending. So that suggests that consumer spending, retail sales as a whole, is going to improve in May, and we're expecting a strong summer. And if we're going to expect a strong summer from spending, then I'm very optimistic, because we know that people's wages are growing, so they've got that little bit of extra money to spend. But helping that disposable income is going to be that effective tax break from the decline in oil prices, which they've experienced for the last 6 months or so, and we haven't actually seen that filter through into spending yet. So if anything, they've got a little bit of extra money in their pockets. I really think we're going to see a strong consumer-driven recovery over the course of the summer, and for me, that therefore means that September is very much still on the table. I've never really wavered away from September as being the point at which they'll hike interest rates. I've been very confident throughout this period that the US was going to bounce back in the second quarter, and I think now we're going to start to see evidence of that.
And Japan's foreign bond investment decreased towards the end of May. However, bonds have played catch-up this month, with yields climbing to the highest since November. Could these changes affect Japan's easing?
Well, I'm not sure if it will directly impact its easing. Now, of course, with the reason we've seen this quantitative easing is to try. It's really twofold. One is to try and drive rates lower. The other is to inject liquidity into the financial system and try and stimulate lending. Now, we have seen yields rise, but this has been a global rise. This hasn't just been Japan. This has been a global rise in bond yields. So I don't necessarily think the Bank of Japan is going to be too concerned about the fact that they've risen to 0.51%. I think the biggest concern as far as the Bank of Japan is concerned is going to be the fact that we haven't seen inflation pick up. Now, I think this hike in the sales tax last year was far more damaging to the consumer than the Bank of Japan and the Japanese government had anticipated, and I think this is the reason why we are going to see further stimulus from the Bank of Japan in whatever form they choose. I'm not sure if they can do bond buying because their bond buying program is already so large that they may have to get a bit more creative. Maybe they'll start buying corporate bonds, or maybe they'll start buying mortgage-backed securities, but I do think we will see some more quantitative easing from Japan because the efforts so far combined with the sales tax hike just haven't been enough, and inflation is extremely low, and there just doesn't seem to be any chance that we'll see inflation hit their 2% target. I think a big concern here is the fact that the consumer just isn't spending. We're not seeing that consumer-driven recovery, and we're not seeing that consumer-driven rise in inflation, which we need, which is going to be necessary. The consumer was put off by that sales tax hike, and you can't blame them. This is an economy where consumer sentiment has been very fragile for 2 decades now. Something like this was always going to happen. Last time we had a sales tax hike, it was followed shortly after by a recession. We shouldn't have been surprised to see that happen again last year, and consumer sentiment takes a little bit of time to pick up again, especially when you're talking about a country like Japan.
Well, thank you for speaking to us today, Craig. That's all that we have time for today. Check back on our week ahead on Monday to keep you ahead of the trading week. Goodbye for now.